Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Alasdair Macleod. How you doing today, Alasdair?
Fine, thank you very much, Darrell.
Yes. So let's start with well, there's a few elephants in the room. I don't know if they all can fit, but there's a few elephants in the room. One is the inflation numbers that just came out, and just curious in your thoughts on that. Obviously, CPI, people refer to it as the CP lie and such, but just curious in your thoughts on the increase in the CPI headline numbers.
Yeah. Well, I like your comment there. I mean, we had a prime minister back in the early 19th century who said, and this is before the days of computers, he said, I can prove anything with statistics except the truth. Wow. So I think that's actually the way we ought to look at these numbers. No, but seriously, I mean, the consequence of the Gulf War hasn't really fed through to these numbers yet. I expect that these consequences will feed through really in the coming months. I mean, the oil situation, the only reason that oil has been hanging around $90 has been basically because the US has been drawing down on its strategic reserves. Other countries have been doing the same. But on the ground in Asia, I mean, some people are having to pay up to $200 a barrel to get oil. So, wow. That's going to come our way. And also, you've also got other problems, and that is that, all the fertilizer shortages and all the rest of it, all that sort of stuff is going to drive up prices. So, yeah, I think, this last CPI number isn't really that material. It's the ones perhaps for July, August, September, which are going to be really important. And I think that's going to drive up bond yields because, higher inflation or lower purchasing power for the dollar is coming your way.
Mm-hmm. Yeah. So, I've been kind of thinking about the signal versus the noise. I was actually, before we got on the call, I was watching a press conference from President Trump, and he was talking about re-engaging in the bombing of Iran and such. And obviously we've been in negotiations. Oh, there's going to be a deal, then there's not a deal, and then there's some attacks. And then, you have these other dynamics with Israel and Lebanon and such. And, all of that, I've been viewing as kind of just more noise, but the strait is still closed. And so as long as the strait is still closed, as long as there's blockades and such, it seems like these are going to continue to exacerbate the issue of oil prices and fertilizers, as you alluded to. I'm wondering, how bad can this damage get? Let's say the strait is closed through the summer. It seems like it could get worse.
Well, it will. And the problem really with listening to the US administration is they are dissembling. What they're saying is simply not true. The fact of the matter is, if you talk to the people with proper intelligence on the ground, basically, Iran has won this war. America's trying to get out. I mean, if you watch President Trump's machinations, it becomes quite obvious that he's trying to get out. Remember, this was something that was meant to be, Iran was going to be conquered over a weekend. Yeah. We are 101, on the day this is recorded, we are 101 days after the commencement of the war against Iran. And we're not getting, it's all heavily censored too. Israel is not allowing any reporting at all about the damage being done in Israel by Hezbollah on the one hand, and also by Iran on the other. And the damage has been quite extensive. Iran has been bombing all the American bases in the Gulf, and basically making them inoperable. And last night, the most heavily hit was Bahrain, which was the home of the Fifth Fleet. So this is not going to stop. Iran is going to pursue this to the point where basically the global economy falls apart. I'm sorry to say it, but that's basically, they don't give a damn. They want Satan out of the region. Satan basically being America. That's their word for America. And they hold all the cards. Look, for example, at this helicopter thing. We can see that this is disinformation. The helicopter was shot down. They started off by saying it collided with a missile. I mean, what a joke.
Wow.
And 2 pilots were rescued. Now, the press here were fed the story that they were rescued by a robot boat with nobody on board. What? It just gets unreal, the whole thing. And do you remember there was a helicopter? Well, there was, I think it was a helicopter. There were helicopters involved, but right at the beginning of the war, there was a plane shot down. Yeah. And the pilots, the pilot was finally rescued. Apparently, he'd sort of, with a broken leg or something, crawled something like 3 miles up a mountain before he managed to get a signal. I mean, the whole thing is a load of bullshit. It really was. But this is what we face: disinformation, complete disinformation. And as to the point, stock markets are working on the basis of this disinformation. They don't know what the hell's going on in the Middle East. They're ignoring it completely. They're believing what they're being told.
Yeah.
And this is unreal. I mean, it really is. I mean, you're on the West Coast. I mean, you're a hell of a long way away from this. And it must seem that it's all in another world. So, but it's not. It's actually very, very serious.
Yeah. Agreed. So, I'm thinking about the recent market performance. A lot of things have been sold off, gold miners, gold, S&P, a lot of these tech stocks and such. It seems like, if and when, this, I guess the truth comes out of whatever the situation, like the markets are like very fragile, just with how much like we've declined in many of these asset classes and such. And so how are you kind of viewing that? Do you think that was just like a normal correction, or are you viewing that as something bigger?
Well, looking at equities, I think they are more overvalued than they have been, if you like, since the financialization of the U.S. economy, which I take to be, sort of 1983, 4, 5, round about then. That was basically when, banks, began to operate in stock markets and all the rest of it as market makers, as investment banks, and all the rest of it. The distinction between commercial and investment banks basically got buried at that point. The relationship between the yield on the long bond and the value of the S&P, that has drifted so far apart now that the S&P is more overvalued than it has ever been since the 1980s, and probably more overvalued than it was in the Roaring '20s, in the run-up to the 1929 crash. Now, that's quite a statement. The problem we have is that bond yields are not going to go down materially. They're going to go up. And the reason they're going to go up is because the consequences of this war will be to drive the global economy into a slump. Now, what that means as far as government finances are concerned is that tax revenue collapses, welfare costs soar. So their budget deficit just goes huge, absolutely enormous. What does that do in terms of the rate at which the US, with 125% government debt to GDP, how is it going to fund this? I mean, the answer is quite simple. they're in a debt trap and they can't really fund it. So what are they going to do? Well, I mean, the answer is the only thing they can do is to do QE, whereby an arm of the government called the Fed goes in and physically buys up the stock that's issued by the US Treasury. This is what's going to happen. And it'll collapse the value of the dollar. But there is no political alternative. The outcomes are not driven by economic analysis, common sense, if you like. They're driven by political, sort of political objectives, politicians. It's always the way, and it'll collapse the dollar. So the first thing that you will see, I think, is you will see bond yields rise above 5%, or virtually the whole way along the yield curve from certainly 10 years onwards. And at that point, the equity market will begin to collapse. And I think the foreigners will take fright. They have got roughly $22 trillion invested in US stocks. They will try and get out. The banks have loaned a hell of a lot of credit into supporting the stock market. I mean, if you look at the hedge funds, they have borrowed both through the banks and also through the repo market a figure like $7 trillion. If you look at brokers' loans, as recorded by FINRA, which is in addition to what the hedge funds are doing, that's another 1.2 trillion. So you've got over 8 trillion of collateralized debt, which is going to be liquidated under these circumstances.
Wow.
So with a combination of the foreigners trying to get out and this debt liquidation as the banks and all the rest of it basically become forced sellers into the market, I think the crash is going to be very, very serious when it comes. And it's always a little man who gets hurt, because what does he do? He can't believe that prices have fallen. And he'll hang on for, if it's going to recover, it must recover. He'll hang on, it'll go down even further. And there gets a point where he will turn around and say, well, it's got to recover, and if it recovers a bit, I'll sell then. But it doesn't recover, it goes on down. He gets slaughtered. And, of course, under these circumstances, where these individuals hold mining stocks, what do? They sell the things that haven't gone down. So mining stocks get hit as well. Now, I think that the level of investment in mining stocks, gold is separate from this story, but the level of investment in mining stocks is relatively low. So I think this is probably an initial effect on mining stocks rather than taking them all the way down along with all the other equities. But if you look at gold, I mean, all the gold is held basically via ETFs. And the level of gold exposure, if you take the 160 trillion of North American portfolio assets, ETF gold exposure in that is 0.2%. It's not that material. It'll generate some selling, some liquidation maybe, but in the grand scheme of things, it will get picked up elsewhere.
Mm-hmm. Okay, so I'm curious in your thoughts on, like, we had this big crash, I imagine, jobs are going to be on the line, and many other dynamics, and which typically sets us back, in terms of on the economic level. But at the same time, we need this copper, we have all of these AI data center build outs. We need the silver. We need these critical minerals and things of that nature. And so, and the mining stocks sell off, and this is something that we need. Do you see this being like a multi-year setback before, like, we have a boom in commodities again, or how would you characterize that?
Yeah, I look at it differently. It's not a question of demand for commodities so much, though that demand will be there. And I think the demand is probably more Asian rather than American, because along with the collapse in the stock market, the demand destruction in America, I think, is going to be enormous. And incidentally, that is also true throughout the G7. So we're talking about the European countries, talking about Britain, we're also talking about Japan. No, it's more what you're seeing, I think, is you're seeing the purchasing power of the dollar and other currencies going down. And this is reflected in higher prices for commodities. The entire commodity complex is in a bull market, if you look at it conventionally. But the best way to look at this is not to say that they are in a bull market, but where you've got the entire commodity complex rising in price, some more than others, obviously, then actually what's happening is that the purchasing power of the currency which you buy these things in or value these things in is declining. This is key. It's key to understanding what is actually happening. Those, the lower purchasing power of the dollar and European currencies and yen for these commodities will feed its way through into consumer items. I mean, you see this particularly with oil, for example, oil energy. You've already got prices at the, gas prices in America rising to the sort of level which is becoming, as far as Trump is concerned, politically destabilizing, whatever. But this is something that feeds the whole way through, that all logistics depend on diesel or gas, if you like. So consequently, the distribution of things, there's a price element there which is rising. You look at food. Food prices are going to rise as well. They're going to rise because of a shortage, a global shortage of fertilizers. Consequently, food prices can rise. These prices can rise. And there is no inflation, if you like, in the sense of fall in purchasing power of the currency being spread elsewhere, if it means that people who buy food have to sacrifice their spending on something else. But that's not the way our economies work. No government can afford that to happen. What they do is they make the credit available for everybody to buy anything they want. That's the whole thing. So they reflate. So what you're going to see is massive QE to try and stave off a slump. But the consequence of that will be to destroy even further the purchasing power of the dollar. And this will be reflected in yet higher prices for commodities, wholesale prices, and also consumer prices.
Mm-hmm. Okay, so there's another school of thought on the potential of a default on the debt and things of that nature. Obviously, inflating the debt away or massive QE. Some people view that as like a stealth way of defaulting on the currency or whatnot. I'm curious in your thoughts on that potential, a default on the debt.
Yeah, well, I mean, if the government can produce its own currency, it won't default on the debt as such, because the currency is a form of debt. It can just print it, and that's what happens. So it's not like a corporation which suddenly has run out of cash flow and sales are down and they can't pay their bills and they're in negative equity and the directors are forced to if you like declare the situation, because if they don't they end up in jail. So no, it's different. The central banks are already bust. I mean, they're already their liabilities already exceed substantially, and nowhere more than this, but in the Bank of Japan, substantially exceeds the balance sheet equity. It's a situation which, if you like, in the private sector, I mean, the directors and governors or whatever of these central banks should be in jail. But no, it's not quite how it works, because they can always print their way out of it. In fact, banks can do this anyway. I mean, an ordinary commercial bank can also produce extra equity merely by creating a loan on the one side, which is an asset, which it has to balance on the other side of its balance sheet, with a contra entry. And that contra entry, instead of it being, say, reflected as a deposit, what they do is they're reflected as shareholder equity. So the liability isn't to a depositor, it's liability to a shareholder. So you can recapitalize any bank that way. You can recapitalize central banks that way. But the fact of the matter is that without the sheet anchor of gold, if you like, securing the value of the currency, so the currency acts as a gold substitute, the value of the currency collapses under those circumstances. And that's what's going to happen.
Mm-hmm. Who gets bailed out in this next crisis? Well, I mean, we're already in. I think we're probably. It's arguably we're in it.
We're entering it. Yeah. And I mean, you look at the price of or the value of the dollar measured in gold, and it's going down. It's accelerating downwards already. So I know that we've had a bit of a correction with the gold price falling measured in dollars. But it's just a bump along the way. The trajectory is quite simple. It's accelerating downwards. Basically, the political imperative is to bail everyone out until the currency is valueless. And that's what will happen. I don't see banks necessarily going bust. Banks will have their problems, but they'll always be rescued out of it. I mean, no banks are allowed to go bust.
Yeah.
Just remember what happened in 2008-9. I mean, the Fed actually decided to make if you like, a scapegoat out of Lehman. I mean, that bloody nearly ended the entire financial system, that decision alone. No, what the central bank will always do, it doesn't matter how big, how small the bank is, they will not be allowed to go bust. And we saw this actually with the regional banks, sort of 4 years ago. None of them went out of business. They were all sort of shifted onto someone else.
Yeah, for sure. So I want to dive a little bit into the psychology, behind, these price movements measured in dollars. Many people were waiting on a sell-off in gold and silver before they wanted to get in or whatnot. But it seems like people are running for the hills in a lot of ways as well. And it's kind of backwards, like you would think like, hey, this is a good opportunity to trade, this toilet paper, currency for real money. And, and you could continue to build from there. This is a good opportunity, a good pullback. I mean, gold's high in dollars was what, 5,600 or something like that. And now it's at a little less than 4,200. So just curious in your thoughts on the psychology that's kind of working behind, these, people that are selling,
Yeah. I think the answer to your question is that they look at gold and silver as investments. They're not their money. An investment, basically, by definition, an investment is something which has greater risk than an alternative, the alternative basically being money, if you like. And of course, everybody thinks that money is cash dollars. And you're encouraged to think that because when you value your portfolio, you value it in dollars. Everything you have to do has got to be accounted in dollars, or, if you're in Europe, euros, or Japan, yen, or in the UK, it's sterling. That is your neutral position. But the reality is that that doesn't allow for the fact that what you're valuing it in actually has counterparty risk. And the counterparty risk is the government. It appears on the issuer's balance sheet, the issuer being the central bank. But make no mistake, this is not final settlement. But physical gold, the possession of physical gold, is final settlement. It's been that in Roman law since going all the way back to around about 448 BC, or was it 548 BC? I can't remember. A long time ago. I mean, we're talking about 2,600 years ago that this was first set out in Roman law in the what's called the 12 tables or 12 tablets. And through the centuries, there was a system of jurors, particularly in the first, second, and third centuries of after Christ, who ruled on this. And a body of law came out of this, which eventually was consolidated in Justinian's Pandex, which came out in about 550 AD. And since then, it's been the basis of all the Roman Empire's successor nations' common law. And, of course, in the case of Portugal, Spain, Britain, and the Netherlands, we all set up dominions around the world, and they inherited all this, including America. So America first accepted our common laws in something called Blackstone's. Now, Blackstone was the rulings, if you like. It was a huge, great multi-volume tome of all the laws. And until America actually had set up its own constitution, set up its own legal situation, it referred back to Blackstone. And Blackstone was indeed the basis of American law. So, you can't escape the fact that final settlement is gold, possibly silver. I mean, originally it was bronze, going back to the very early Roman law days. So, and it works because people understand that gold is final settlement around the world, so that your currency, if it's not tied to gold, I mean, you've got the risk of your currency, but if you've got gold, because it's accepted by everyone as final settlement, we're talking about physical gold, then that's fine. And the great thing about gold is that its value doesn't alter. I mean, okay, it fluctuates a bit, but over long periods of time, it just goes along like that. Whereas the value of currencies, fiat currencies, goes down like that. No fiat currency in history has survived for very long. And I can tell you that the current fiat currency system is not going to survive for very long either. So coming back to the psychology of the situation, of course, investors don't see this at all. They've had the idea that gold is money and the rest is credit driven out of their minds by propaganda, particularly from the US Treasury. And that really came about in stages, but was finalized by the abandonment of the Bretton Woods system back in 1971. So they don't know. And the fact they've got to account in their own currency for tax purposes, for value purposes, for everything else, they see that, their own currency, as being, if you like, the neutral risk situation. But it's not. Neutral risk situation, or the zero risk situation, is actually physical possession of gold. Investors don't understand it. They're going to wake up to it. And they will wake up to it kind of late. But this is why central banks are buying gold, because they know the law. And the other thing is that when America turned around and started weaponizing the dollar, this is another thing. This is another reason that you don't want to hold a fiat dollar, because the government, is going to use it against you. So you can see that, basically, a lot of this is actually down to, the US government and trying to get away from the strictures of gold in the first place. And then finally getting so confident that they are masters of the universe in terms of, the dollar is now money, and it's replaced gold, which is a pet rock and all this crap. I mean, basically, they got so arrogant about it that they weaponized the dollar. So what happens? People who haven't read the script think, hold on a minute, we don't want any of this stuff. And that's what's happening. And this is actually, behind the whole of the Middle Eastern crisis, really. I've had people say, well, don't the Arabs need dollars? So they'll sell gold for dollars. Well, for a start, it's not the countries that hold the gold. The gold in that region is basically held by wealthy families and the sheikhs themselves, as it were. But they're up to their necks in dollars. They don't need to sell gold, for goodness sake. I mean, they've got so many dollars, they can do what they want with the dollars. What will they do? I mean, the only thing they can do is sell them, which they will do.
Yeah. Yeah, so the central banks buying, I've been seeing the different charts saying like it's resumed. I don't know if it just kind of paused for a little bit or if there was a little more selling pressure, because I think Turkey and Russia had sold some gold reserves. It may have been minor compared to like how much they've bought in over recent years.
Turkey, the private banks, the commercial banks hold a lot of gold for their customers and also for themselves. The central bank holds gold. What happens is that there is gold which flows between the central bank and the commercial banks and back again. This idea that the central bank sold gold is not true. What happens is that it uses gold as a means of regulating the money supply in Turkish lira. So it will have exchanged gold with commercial banks, if you like, drawing Turkish lira out of circulation to try and control its purchasing power. So, what Turkey's doing has got nothing to do with selling gold. It doesn't leave the country. It really doesn't. That's the first thing. The second thing is that it transpires that Russia, her gold mining operations, have been spectacularly successful. In this last year, apparently, they have managed to overtake China as the largest mining nation in the world. So they have excess gold. And I think that as a matter of policy, you've got quite enough gold. I mean, I can tell you that it's not just the Russian central bank, which has got about 2,400 or 2,300, I don't know, figure like that. But as well as that, the two sovereign wealth funds hold a further 10,000 tons. So put all that together, Russia's got considerably more gold than America, or what America says she has, which is a big open question. And her population is 1/10 of it. No, it's not 1/10 of it, but no, I think it's about a quarter of America's. Mm-hmm. So, Russia actually could go on to a gold standard tomorrow. And indeed, wow. Sergei Glaziev, who was one of the chief economic advisors to Putin, actually recommended this in a paper back in, I think it was just after the special military operation. So we can put the ruble on the gold standard, and they can do it. They can do it tomorrow if they wanted to.
Yeah. What are your thoughts on silver?
Silver is basically an industrial metal. Okay, we've got sort of overtones, if you like, of monetary metal. But at the moment, I think we're best to regard it as an industrial metal. Demand for it is going off the scale. Of that, there is absolutely no doubt. China has reversed its policy towards silver exports. What we didn't know when China brought out its policy of severely restricting the export of rare earths, at the same time, it produced a similar policy for silver, but this wasn't declared. This led to a lease rate. I mean, this happened in the end of September last year. Lease rate in London in early October the 9th, shot up to 40% and was the beginning of the move of silver from $50 all the way up to $120. That was sparked effectively by China withdrawing from providing silver to the global market. The cover basically was they were saying they were changing the licensing regime from January the 1st, but that actually doesn't really matter. She's still exporting, or has been in the first quarter, and but what we're looking at, I think, is exporting on pre-agreed commitments, as it were. But meanwhile, China has imported huge quantities of silver, record amounts in the first quarter, and is really depriving the rest of the world of silver's liquidity. And another reason they're doing this is because the US Geographical Survey recommended that the government should declare silver a critical mineral, which it did, and the Chinese were not going to supply America with this critical mineral. So the result is, at a time when everybody's getting into manufacturing photovoltaic cells, and you've also got, electric vehicles, and you've also got, these sort of super duper data centers, which can consume huge amounts of silver as well as copper, obviously. And you've got the need to rearm. I mean, weapons stocks, missiles and all the rest of it are depleted. They need lots and lots of silver for those, which just get completely destroyed, etc. So, there's no recycling of that. It's just there is a huge shortage of silver around the world. I mean, it's as simple as that. And sooner or later, it's going to get driven up, and it will. At the moment, I think what we're seeing in both gold and silver is there is a little bit of liquidation, I think, of sort of ETF type holdings in China. I understand 2 silver ETFs have closed recently. So you've got, there was some speculative buying in China. Of course there was. And there was quite a bit, I think, on the Shanghai Futures Exchange as well, despite the fact it's a physically deliverable contract. So, but I think that's probably working its way out now. Meanwhile, of course, the swaps, who are basically the market makers and bullion bank trading desks, have been very, very short of silver. And they're banging the price, trying to get their position back. But if you look at open interest on COMEX, it's the lowest it's been for 20 years. And I was looking at the position of the managed money category, and again, their longs are the lowest they've been for 20 years. So, what have we got? I mean, the only way in which silver futures can be driven down is for people to actually go short of silver. And I think that's basically what the swaps category are hoping. They're probably trying to persuade hedging as well by producers. In other words, the mine's hedging, their forward production. And on a fall like this, I mean, I can imagine a bank like JP Morgan or whatever, working in conjunction with Glencore and Trafigura, persuading silver miners, look, when you sell your production forward, at least you know what you're getting.
Yeah.
You're going to take the price risk out of it. So, and the management of these mines have got bills to pay. So, yeah, it's an attractive argument, even at $60 an ounce. So that sort of thing will go on, and they'll try and get as much silver as they can possibly get back. And I see also that if you look at silver stocks on COMEX, I think for the last 3 days they've been rising a bit. So a bit of silver is coming in. They want a lot more. It's all about these guys trying to get their books straight before the next run. That's what it amounts to.
Yeah. And any final thoughts as we get ready to wrap up on the miners? So even at the current levels, measured in dollars where gold and silver currently sit, the miners are still producing good cash flows, especially when their all-in sustaining cost is, let's say $1,300, $1,400 gold. Even if it's at like $1,800 gold, they're still producing good margins and such. And so, any thoughts on the sell-off in the mining companies?
Well, I think it's inevitable because they tend to follow the price. And the other thing is that now things are looking a bit more febrile in broader equities. I think, again, people are sort of looking about securing profits rather than looking forward. I think in more stable markets, I could see brokers, analysts actually pointing out exactly what you've been talking about. The earnings prospects for XYZ mining company, et cetera, doing the analysis, looking at this, looking at that, and concluding that, they're cheap, you should buy them. But people wouldn't be listening to this message at this stage. I think there's just too much going on for them to think positively about the mining sector.
Yeah.
And when you see gold being marked down from, 5,500, which is more or less the top, down to the current 4,200, probably go down to 4,000. I don't know. You can see that people are not going to look at this positively at this moment in time. So I'm afraid that the mining sector, it needs to see things recover, if you like. If you get a decent recovery in the gold price, the silver price, which basically means the dollar's going down again, then I think that you'll find that the mines will really start to perform. But you do have this problem that with the potential for the rest of the equity market to crash, they've got to work their way through that. And so, it's difficult for investors to work this one out. I mean, I know
it's your hats.
If you're looking at value, then you don't argue about it. I mean, it's quite simple. Buy value. But it means you've got to be able to ride the ups and downs of the market. And of course, that takes guts, particularly for a fund manager who's, sort of, if you like, he's marked against, benchmarks and all the rest of it. So you're not going to get, value managers not going to really drive this market.
Yeah. So people got to hold on to their hats.
I think it'll change. Yeah.
Yeah, for sure. Investors got to hold on to their hats, strap up, tighten their belts, and all of that, especially with the volatility. So, Alasdair, appreciate you for your time and everything. Where can the audience connect with you, ask questions, or read some of your publications?
Well, I do Substack, which is macleodfinance.com. You can go there, MACLEOD finance.com. That'll take you to my Substack. And, I try and give information to people which helps them understand actually what is going on. And I have to say, it's a very different message you get from me from what you get from this sort of propaganda and also the major brokers. My whole approach is different. It's founded in reality rather than fashion, rather than propaganda. I'm glad to say that quite a lot of people have signed up for it, and I would encourage everybody to do so.
All right. Well, you all be sure to go over to Substack to Macleod Finance. Check out Alasdair's publications there. We appreciate you all for watching. Be sure to hit the subscribe button if you haven't subscribed yet. Let it how you support. Thank you all for watching, and thank you, Alasdair, for your time.
Thank you.